Hello everybody and welcome to this afternoon's webinar where you'll be learning to master the 5 cash flow keys with the help of 2 fabulous presenters from DFK ANZ. Now my name's Angela and I'm your host on this webinar today before I introduce you to our presenters. And you'll be learning about how to boost your business growth in 2016 by looking at the cash flow keys that you can control and make a big difference with. You can just pop to the next slide. Now, I want you to approach this webinar with some great quotes here that have been shared with us. We consider turnover is vanity, profit is sanity, but your cash flow is the reality for your business. And that's why we're spending so much time focusing on it with you today. Now, the hosts that you have today, we have 2 fabulous presenters from DFK. One is Michael Gray, who is a partner at our firm in Adelaide, DFK Gray Perry. Now, Michael has got 30 years experience dealing with a broad cross-section of small to medium businesses, helping them with business management and taxation advice. Now, Michael is actually the author of Gray's Small Business Control, a book that really focuses in on cash flow management. So he's got some real at the coalface experience that you'll be benefiting from today. And then Melissa Healy is a partner at DFK Everalls in Canberra, who is also cracking up almost 30 years experience right at the coalface working with small business clients, helping them get up and running. She has much experience in also presenting training courses on tax and business management for small business people, and is the facilitator of the New Futures in Small Business program for the ACT government. Now, both Michael and Melissa specialise in plain English advice. We're not going to be running around with lots of jargon today. We want to make this very applicable and tangible for you to be able to put this information into action in your business to take control of that cash flow again. So what will we be looking at today? Well, it's our goal to be educating and empowering you. We really want you to be able to confidently take control of your cash flow, because when you can do that, your business future is in your hands. It's no longer left to chance. And so there's some key points that we'll be taking you through today. We're looking at cash versus profit, the significant difference between those two. And although you can have a profitable business, the cash flow or lack thereof can really bring you undone. So looking at how to create a cash flow budget and to actually use it to guide your decision making, not just having this as, well, there we go, I've ticked that box, I've done that statement and I'll worry about it later. It actually is a working document, and we'll be taking you through how to utilize that with a great tool which you can download. We'll also be looking at your short-term cash management strategies, which differ enormously from the long-term strategies. You need this real mixture and different perspective on both to have that control in your business. And then very importantly is the 5th point, the right finance for the right purpose. There's many different types of finance that you can secure, but asking yourself the questions as to which is the appropriate one for you in your business at this moment, because that can change over time. Now, just some other housekeeping that we're wanting to share with you is that we are offering an opportunity for some direct assistance. We have 15 cash flow management strategy sessions that you can apply for and win. And I'll give you the link to be able to do that towards the end of this presentation. And it will also be emailed out to you. So there's plenty of time for you to apply. A few other pieces. You will see on your administration panel, that's to the right of your screen, there is a couple of handouts. There's an Excel document, a cash flow template, which Melissa will be referring to, but it's very helpful for you to utilize this after the call as well. And there's also a PDF of our top debtor tips. Now, Michael will be taking you through some of these tips, but then there's lots of other ones that our guys know from many years of experience that if you utilize will make a big difference to getting your debtors to pay you on time, which everyone in business really, really wants. There's also ample time for you to ask questions specific to your situation. Again, on your admin panel, you'll see that there is, there's a wee area where you can type in questions as they come up throughout the presentation. We will actually pause at the end and go through those questions together rather than stop the flow of the information that's coming through. But if a question comes to mind, please type it in and we'll make sure that we take care of that. Now, lastly, before we get started, I'd like to just start with a quick poll so we can have an understanding of who is on the line, because that helps us to personalise this presentation more for you. So I'm just popping up a poll now that is asking which business is your industry in. So if you can take a quick moment to tick one of those boxes, and we'll display the results for everyone to see so we can understand the cross-section of people that we have on the line today. So if you can take a quick moment to tick the box, we'll just wait for a few seconds and then we'll display the results for everyone to see. So thank you for doing that. Okay, they're coming through. We've got a lot of professional services on the line as being number one. Lots of others. Unfortunately, we couldn't cover everything, but you can certainly let us know if you'd like to send an email later on. We've got manufacturing, hospitality, and retail. So just waiting for a couple more moments, and then we will display the poll. Okay, so as you can see there on the screen, that's the sort of split that we're looking at, everyone who's joined us today. So thank you to all of you for popping those buttons there. And again, apologies that I can't find out all the others, but there's plenty of chance for you to share that with us, especially when you are applying for your strategy session. Okay, so that is the housekeeping. So hopefully that was all nice and straightforward for you. I will now disappear into the background and hand over to Melissa, who'll start talking you through the back to basics of cash flow. So I hope you enjoy the information. Melissa, over to you.
Thanks very much, Angela, and welcome to everyone watching. I'm going to start this webinar today by taking us back to the basics. So what is cash flow? It's very important for business owners to understand the difference between cash and profit. You know, profit is simply calculated as income less expenses, whereas cash is simply how much money you have in the bank. Your net cash flow is the difference between the money coming in and the money going out. Now, the amount of profit you have made during a year and the amount of cash you have in the bank at the end of the year are rarely the same, and getting them confused has caused problems for many businesses. Cash flow is the most critical of all KPIs for obvious reasons. You need cash to pay your bills on time. Without cash, your business can end up in trouble very quickly. But you also need cash to grow your business. So, for example, to fund extra working capital so that you can buy more stock and things like that, or to buy more equipment. You also need cash to pay back loans with, and who can forget that the tax office wants their share too. So where does cash come from? Well, it can come from your own pocket when you're starting out, and that's called the owner's equity or loans from the directors and shareholders. Or if you have to borrow money, then cash can come from people or the bank lending you money. And cash obviously comes from customers when you sell them your goods or services, COD, or when they pay your invoice if you let your customers run accounts with you. So, as I've just mentioned, profit is not how much money you have in the bank, it's simply the difference between income and expenses. A business can actually be very profitable if it's paid for all of its expenses, such as wages, stock, rent, things like that. But if the customers haven't paid yet, then the business might still have cash flow problems, just because it hasn't come in yet. So businesses becoming insolvent despite being profitable also happens frequently. It can happen when a business spends the cash from the profit on big equipment or a new car and things like that. The expenses associated with buying equipment is not the cost of the equipment, but rather the depreciation, which is only a percentage of the cost. So in other words, if a business spends all of its profit on new equipment, this will result in all the cash being spent, but not all the purchase payment will qualify as an expense, and therefore the business will still have made some profit, which will be taxable, but there isn't any cash left to pay the tax with. So that's one of the key reasons why a lot of small businesses go broke in their first couple of years, because they haven't budgeted on that properly. Businesses can also get into trouble when the owners spend the money on their personal expenses or paying dividends, forgetting to leave enough cash in the business to help cover inevitable quiet patches or simply to pay the tax bill on the profit that they've already made. So anyway, to avoid problems, it is important for businesses to therefore have both an income and expenditure budget showing how profitable they are, as well as a cash flow budget showing the cash inflows, outflows, and the cash balance for each month. So let's have a look at how easy it is to create a cash flow budget. Actually, before I show you how easy it is to do it, let's just do a quick poll. So, Angela, if you can get that up and running. We want to know how many of you have a cash flow budget already that you're monitoring regularly. How many of you have a cash flow budget but it's in the bottom drawer? And how many of you haven't quite got around to preparing a cash flow budget yet? So we'll just give you a couple more seconds to answer that. Okay, so the good news is, yeah, we've got 50%. Yes, absolutely have a budget that they use, and 50% no, but I know I need one. So that's good. So roughly half and half. Great, okay. Quite often we find that a lot of businesses don't have one because they think it's too hard, or they think it's going to take too long to organise one, and after all you are only forecasting the future. But anyway, let's get into it and show you how easy it really is. So the main thing with a cash flow budget is to keep it simple. So to improve your cash flow strategy and ensure your cash flow is under control, have a cash flow budget, even if it's just a rough one, because any cash flow budget is better than none. So don't stress about it, just have a go and keep it simple. Use Excel to prepare your cash flow forecast. You set it up with 12 columns for the different months, and to show you how easy it is, we've attached a handout to the presentation, and this is what it looks like. So it's a little bit hard to read on the screen, but that's why we've given it to you as a handout, and I'll go through it with you in a bit more detail now. So, and that can get you started without having to start from scratch. So this template comes from business.gov.au, which also has a great variety of resource materials for small business people. So these are the different rows on that spreadsheet. But from a practical point of view, I personally find it easiest to start with the outflows. So when you're actually trying to fill in your spreadsheet, start with your outflows, split them up between fixed and variable expenses so that you can have a different row for each expense if you like the detail. But on the other hand, if you want to keep it a little bit simpler and you just want to lump some expenses together, that's fine. So for example, you could put all your office administration expenses together, such as printing, stationery, postage, all that kind of stuff. You know, lump them all into one line, whatever makes it easier for you. Once you've got your fixed and variable expenses sorted out, you can add your capital equipment purchases, so that's the purchase price of any equipment that you're going to be needing, as well as your loan repayments and tax payments. So that gets your outflows all under control. Then it's easy to go back and fill in your inflows. So that's obviously all your customer payments, but please note that if you're a COD kind of business, well then obviously that's when you make the sale, the cash is going to come in. If you're a business that issues invoices and then has to wait, say, 30 days for people to pay you, well then it's going to be a little bit longer before the money actually comes in for that. So you might like to do a little bit of a sub-budget that says, well, this is what I invoice each month, but this is when the cash actually comes in, and it's that cash flow that then feeds back into your cash flow budget. If you've got a particular project coming up and you're borrowing some money, those loan proceeds will be another line item in your cash inflows section. And of course, if you've had to dip into your own pocket to help support the business, then that's capital introduced by you. When you do your inflows, please take into account any seasonality issues, such as Christmas holidays or whatever it is that's relevant for your business. I remember having a florist client in my early days, and so of course Valentine's Day and Mother's Day, as well as Christmas, were, you know, our best months, so to speak. So take whatever seasonal issues into account that you need to do. So once you've done that, you work out your forecasted closing cash balance at the end of the month. This closing cash balance for one month then becomes the opening cash balance for the next month. So that's where Excel comes in handy, because you just put your little formula in. Now, closing cash balance at the bottom of the page for a particular month isn't a positive amount, and you don't have an overdraft facility, then you know that you've probably got to go back and tweak something to ensure that it doesn't go negative, or maybe you simply need to talk to the bank manager about a temporary overdraft. Now, overdraft applications are much more likely to be approved when the bank manager has been given enough warning beforehand rather than you not applying until you already have a problem. And that's the whole point of doing a cash flow budget. You want to get a warning about when things are going to be a bit tight so that you can do something about it now to avoid it or deal with it, rather than waiting until it's all too late and to do anything about it. We'll talk more about overdrafts and finance later on. Now, the last thing I want to remind you about cash flow budgets is that, like with everything in life, preparing and updating cash flow forecasts get easier with practice and experience. So after you've prepared your cash flow budget, don't file it in the bottom drawer. As each month progresses, keep comparing the budget to how you're actually going so that you can see how things are going. And at the end of each month, work out what your actual closing balance was and update your spreadsheet accordingly so that you don't get too far adrift. So obviously this is a forecast. You're just forecasting what your cash flow balance is going to be at the end of each month. By the time you get 12 months down the track, you're going to be potentially a fair way out of kilter. So by updating your opening balance each month to what it really was, then you'll keep your cash flow budget on track. And of course, one of the important things is to review what and why things have turned out differently to the actuals last month. The whole point being that you want to learn from that. So what business strategies worked and didn't work? So what do you need to tweak there? Or what have you learnt in terms of your budgeting skills that so that you can become a better forecaster of what's going to be happening in future? So, as I said before, having a good understanding of your cash flow will help you stay out of trouble, thereby saving you money by paying less fees, interest and potentially penalties, or better still, managing your cash flow properly will make you be in a position where you can actually take advantage of opportunities as they arise. So, just to wrap up that section and what we've looked at so far, we're recommending that you find some time this week to review your business's cash inflows and outflows, prepare a simple cash flow budget, identify and resolve any issues that it highlights, and then review that budget each month and fine-tune it as necessary so that you don't get too far off track. If it's still all too daunting or you just want somebody to double check it for you, don't forget to apply for one of our 15 free cash flow strategy sessions that will give you more information about at the end. So that's enough from me for the moment. So I'm going to hand you over to Michael Gray to talk to you more about working capital and lots of practical strategies to manage your working capital more effectively and therefore minimise your cash flow problems. Over to you, Michael.
Thanks, Melissa and Angela, and good afternoon to you all. So I've got about 20 minutes, which is probably not quite enough, but what I'll be talking about is the short and long-term cash management strategies, which in essence is really all about manipulating that cash flow budget that Melissa's been talking about to your advantage. So let me just dive straight in, and firstly let's talk about short-term. Commonly defined as working capital, I suspect most of you in business have heard that term, but to make it simpler, it is really just simply about the cash needed in day-to-day trading. It's present in all business types, whether they be small or large, and it's a critical part of a successful operation. And it's also the most stressful, there's no doubt about that. In my experience, that is the one area that constantly comes up with clients. It keeps you awake at night. It drains your energy, it drains your passion. And I must say it probably contributes to many less than optimum business outcomes. So why do you need to be managed? Why does it need to be managed? Well, if you happen to be an early startup, for example, your costs are outstripping your revenue. It's a problem. If you're going through a growth spurt, which you would expect that to be a very positive outcome, nevertheless you need resources and more money is going out the door than perhaps coming in to replace it. Sometimes you need your stock to be boosted during high usage periods, and then you're holding stock on the shelf, and that's cash on the shelf. You might have a slow-paying customer. All of a sudden, someone who's been a very good payer suddenly falls into difficulties, and then you fall into difficulties. And of course, there's our old friend the ATO, and he demands his BAS and his tax payments. And then you've got Christmas trading effects. So there's plenty of reasons that cash flow becomes a problem, And I guess the question is, what can you do about it? On a macro basis, there's things about pumping up your cash through equity, retaining profits, and borrowing more money. But I suppose what I'm going to show you today is there's also many, many micro things that you can do to help you manipulate, as I say, your cash flow budget to your advantage. And they're basically divided around the debtor management, creditor management, and some stock control. So, to the management of cash in, and that's what we're talking about. How do you speed money coming in? What we've done in the slides is looked at debtor management, I suppose, around the relationship that you would typically have, which is in 3 stages, where you effectively, before you actually do a job for somebody, then while you're doing the job, and after you do the job. So we've got our top 5 debtor management tips there on the slide that we think are important. There's actually a handout on your control panel which takes it up to 16 opportunities. But I guess the key to all of this is there's nothing in stone, and nothing ventured, nothing gained. And my own experience in over 30 odd years of dealing with business is that you've got to be constantly dynamically working the cash flow, and you can't just rely on it being a constant. So there's your first piece of advice. So under the heading, if you like, of before you take over the cash situation, take the time to check the credit rating of new customers. It certainly saves grief in the future, but we also understand that chasing sales is far more interesting and far more exciting than going to collect the cash. One doesn't go without the other. Secondly, have a good engagement process, providing accurate quotes so that you know when the money is due, and you should then follow that up further with a system that actually chases people to the day they said they were going to pay. What I've also discovered over the years is there's such a thing as a rubber band effect, where if someone takes another day or 2 days to pay you and you let them get away with it, it stretches to 3 and so it goes. It's a slow process, but it grows. So you have to be onto it all the time. It is a good idea at number 3 there to get your deposits or payments up front, particularly when you're going to be expending large amounts of money yourself up front so that you can match the ins and outs. And don't be afraid to ask. People are willing to be fair, I've discovered in business over the years, but it is not going to happen if you don't communicate. Number 4 then, for service businesses, and we've got quite a number online, those of you may carry work in progress. It is important to try and arrange what's called progress invoicing so that you're not carrying large amounts of work in progress to the end of the job. So in other words, you're invoicing as you go along. That gives you opportunity to receive the cash as you go along. Format your invoices properly. This is a good one. We use it ourselves, but it's important to put an actual date that you expect to get paid. It's no good giving people 14 days or 30 days from end of month or from some other date frame. It's very useful to put a date, and again, most people comply. They can do that by simply putting it into their diary. I'll just take you through a few. You've got it, as I say, on the handout there on the right-hand side of your control panel, but there are a number of others that are probably worth looking at. I think one of the other ones, obviously, that is important these days is make it easy to get paid 24/7. There's so many ways of payment these days, and people are very, very familiar and very happy to use BPay, FPOS, credit cards, website facilities. So make it easy. Sometimes it's important to offer discounts. It's reasonable to do so if you think it will speed up payment. And again, remember, this is just a process in speeding up money to come to you. So don't waste time by not communicating. Don't wait for people to get around to paying you. Call them as soon as the invoice is due, and that means you've got to manage your aged debtors. By the way, for some, debtors might be called accounts receivable. Same thing. But it's important to have them the ability to age them. Are they 30 days, current, 60 days, 90 days, something like that, so that you're managing it proactively. So proactive is the word here. And another one that I think is pretty important is don't send out statements to customers or clients and expect that's enough. Most people just put them in a drawer or put them to one side and take it as read, if you like, but don't act upon it. It is better to manipulate a letter that is reasonable and fair and just ask the question, why is it that you haven't paid? And of course the phone is still an important part of this whole process. So in summary, around debtor management, it is really about getting the money in quicker. Nothing more exciting than that, nothing more complex than that. And there's a number of little steps that you can take which can make a very big difference to your cash flow. And I suppose the absolute key element, just to finish on that, is that it's timely communication. Get onto the phone, get onto the action as soon as you can, and you'll get the results. So there's two sides to cash flow. One is the money coming in, and of course the other is the money going out. And this is the creditor management management tips that we're talking about. And really, if you think about it again in summary, all we're doing here is looking to slow down or reduce the payments or the dollars going out. So in this way, we're manipulating our cash flow. Negotiation, you'll see there, extended payment terms. Again, that is a function very much of getting up and making the call, making the communication, and certainly the ATO can fit into this category. It is important to speak to them earlier rather than later, and it goes back to what Melissa said about a cash flow budget. It gives you some idea of the future and puts you in control as opposed to a crisis, so that you can ring in advance of the problem. You've got time to work on the problem. Number two, they're asked for bulk and volume discounts. That's important, but of course if you're not tracking whom you're spending money with and don't know the volume, then you're going to miss out on opportunities to put it to them that it would be to their advantage, if you like, to help you along to continue to build their relationship with you. Discounts for early payment, well, that is a very common out there, and people are more than happy to accommodate. So I'd be putting that one up there right up the top. The supplier support for advertising and marketing, again, it can work in certain industry types and certain business types. It's a norm, if you like, not all. But of course it gives you an opportunity to get something back in terms of a rebate that can help you push your sales. The point there about not paying them too early and not too late is a very fine balancing act. It is not destroying your relationship, but at the same time not paying COD unless you're getting a discount for it. Again, in experience, certain people don't like carrying credit and they like to pay immediately. That's wonderful, but unless you're getting something back in return for it, you're probably impacting on your cash flow unnecessarily. So just moving to the next slide there, that the creditor management tips around managing supplier relationships, which follows under what I've just spoken about. There are two distinct strategies. One is to build and nurture, and one is to be, I guess, very harsh in your relationship. But I think you've got to consider what it is, where you are in your journey, the access to suppliers, how many they may be out in the marketplace, and what sort of win-win can you offer people so that you can all grow together. And I would suggest that that's probably the better option as you move through. Finally, under the heading of creditor management tips, we're just a little bit there about stock management. And just to come back here, the three mains that are involved in working capital are your creditors or accounts payables, your debtors or accounts receivable, and if you carry stock or work in progress, this area here. Now strategically, if you are going to be the business on the road that has the most stock, and that's why people come to you, then you're going to have to carry more stock on the shelves than perhaps your competitors, and that takes away your cash. So, and that has implications around storage, around cost, and around stock going out to date. If you operate on the just-in-time methodology, that's better for your cash flow, but of course if you're bringing in supplies from overseas or it's seasonal, then you've got to factor that into your strategic thinking around this area. But there's no doubt minimizing your stock holding on the shelves or in your work in progress or your raw materials, finished goods if you're a manufacturer, is an essential means of releasing cash, and that's what this is all about, by the way, is releasing cash back into your business to enable you to grow. And so just in summary, before we move into the section on long-term finance, is without proper strategies built around short-term cash management, you're operating in what's called a crisis management. It inevitably leads to less strategic decisions. It inevitably leads to less long-term planning. You waste a lot of energy and a lot of passion, and there's far too much stress, and I've seen it many times before where people simply don't take full advantage of the opportunities that their business offers them. So, and the key to all of this is communication in a timely fashion. So just to finish up on the act now, clearly I'm talking about reviewing your debtor management systems so that you're on top of it. You're chasing down aged debtors. Likewise, review your creditor management system. Find ways of slowing down the money going out, or at the very least minimizing the money going out. And certainly reviewing your stock management. Consider it in light of your strategy. Consider it in light of the length of time it gets to come from the supplier to yourself. And amongst this, you should be able to release a significant amount of cash, and it's a rule. So moving on now to the long-term cash management. This area is, I guess, more around your, once you've got your micro in hand, then it's looking at the macro situation, the bigger picture. And just in terms of definition, I suppose, and for those that you are keen to understand balance sheets, then you would find this under the long-term debt position. And it's the sort of money that you would use to set up or buy a business that you're intending to be in for some length of time. It is the sort of money that you need to reinvest in the business to kick it up to that next level of growth. It's the sort of money that you would use to buy your assets, your equipment, and your space to provide the resources within which you'll operate your business. And the last dot point there around core debt, that's important, because over time it is possible that your overdraft facility, which you may have as just a normal part of running your business, your cash flow, it has a peak and a trough, and it should always go into the positives if it's being used correctly. It's an expensive form of finance, and Melissa will talk to you further about that later on. But for this exercise, what you've got to be doing is determining if an overdraft facility doesn't go below zero, then there may well be a core debt in there that you should pull out and rearrange with a bank at better terms and better rates. So I'd encourage you to consider that. And of course, that's what your cash flow budget is all about. It looks to the future, determines that that's your position, and then gives you the time to go back and make some adjustments. So let's look at long-term cash management strategies. And again, it really is coming down to your own management of the medium to long term. Firstly, it's important to be able to provide yourself with financial information on as often as is important to you. And I say that because some businesses can simply get away with a quarterly profit and loss, their financial history, if you like. Others may need to see it on a monthly basis. It just depends on your business type, because if you have too much, sometimes you get too much of a jagged situation, whereas if you take it over a longer period of time, you can see the cycle of your business better. Whichever way, what you're looking for is key performance indicators that can suggest that change is in the wind or change needs to be made. And again, it's all about timely action. And it flows naturally to the next point there, that plan. Be aware of seasonal trends. If you're coming up to the Christmas trading period and you know you're going to have to stock up a significant amount of stock to carry that, then you also realise that that will be paid for in January, February, which is traditionally perhaps a slow period for you, and you'll need to have some facilities in place to carry that. That's also, of course, where you may well have the BAS payment, the GST, from that busy period, that has to be paid out. So there's a significant of things around that point which could impact badly on your cash flow. All about getting ahead of the game, knowing it's coming and making some adjustments for it. Reviewing a strategic plan is a really important one, because ultimately, if you're starting out or if you're on an early phase of your business journey, you need to know where you're going. Are you looking to grow the business to multiple sites? Are you looking to grow your business to an overseas sites? Are you looking to have, as I said earlier on, the most stock on the shelves to make a strategic advantage for yourself? All of this ultimately feeds back to an impact on your cash flow. And so that's why having a good handle on your long-term direction fed back into your short-term cash flow planning is really about working these things together. So in summary, around all of this, it is really trying to find a way through so that you're not operating on a crisis position. You're wanting to get into control. Once you've got that control around your cash, then you're in a very strong position to take relevant plans, make relevant plans, and more importantly, to make decisions around those plans. As I said earlier on, the worst case scenario is you're running around worrying about your cash flow and you've got no time in your head to make these long-term strategic decisions. So that's enough for me. I'll hand back now to Melissa to take you into the right finance. Melissa.
Thanks very much, Michael. Before we dive into all the different types of finance, can we do a quick poll just to see where you as business owners have got your money from in the past to establish and run your businesses? Angela, can you get that up and running? So we just want to see how many of you have used an overdraft or a bank loan or equipment finances such as a lease, chattel mortgage or hire purchase agreement, or maybe you've been able to use a variety of those. Okay, just give you another few minutes to do that. Okay, so we've got about 30% of people who've used multiple sources of finance. We've got 17% with an overdraft, 20% with a bank loan, 25% with equipment finance, and 47% of people have got their money from other sources. So that's great. That means we've got a wide variety of experience with you, so that's wonderful. Okay. So just before we race off and borrow more money, I just want to remind you of some of those things that Michael's just gone through with you. So if your business seems a bit short of cash before you race out and borrow more money and incur a whole stack of bank fees and interest, please have a closer look at your cash flow management strategies. Could you free up a bit of cash by getting your debtors to pay on time more often? And if you've just got through a short quiet patch, can you call in a favour or two with your creditors and get your terms extended just for a month or two? Saves you fees and interest and stuff. But if that's not enough, then fair enough. Let's go and have a look at other sources of cash. So we can either look internally, i.e. from the owners, or we can look externally, borrowing from somebody else, for example, a bank. The advantage of borrowing effectively internally is that those loans are usually interest-free and have very flexible repayment terms. Whereas when you're borrowing externally, you've got finance application fees, you're going to get charged interest, and there might be minimal principal loan repayments required as well. So let's go and have a closer look at the different types of finance and how they work and what they are best used for. So we split them up into two different categories. So just as Michael talked about short-term cash requirements versus long-term cash requirements, we do the same thing with the finance. So working capital should be funded via short-term facilities. So for example, those are overdrafts, line of credit, loans from the owners, debtors financing, stock finance, and of course supplier terms, but don't stretch them too far. Talking about overdrafts in a little bit more detail, overdrafts are simply a bank account where the balance is allowed to go negative with prior approval of the bank, of course, otherwise they bounce your checks. This type of finance is perfect for businesses who have to pay out for various expenses before the money from the job or customer comes in. The idea with an overdraft is that the balance goes up and down during the month, but it should go positive at some stage during the month. The reason for this is that an overdraft is a relatively expensive form of finance. The interest rates are higher than, for example, a mortgage, and that's because it is so flexible and you only pay the interest on what you're using it for, the amount that you're using. Lines of credit, these are getting more and more popular as people have spare equity in their home that can be used as security for business finance. They have the advantage of being very flexible because, again, the balances can go up and down during the month and you only pay the interest on what you've borrowed. And they can also be interest only if necessary, so that's very handy sometimes. Not sure how many of you have come across debtor financing or factoring. This usually only works with business-to-business sales. So the business can issue an invoice for a job, and then rather than waiting 30, 60 or 90 days to get paid, they can actually sell that invoice to a factoring finance company who will pay them, say, 90 cents in the dollar straight away, rather than the business having to wait for the customer to eventually pay them. Then the customer eventually pays the factoring company direct, at which time that factoring company gives the business another, say, 5%, and it keeps 5% for itself as the fee and the interest charge on that. The percentages paid out and kept will depend on the type and quality of the business, like any loan application. But factoring is really handy when you don't have bricks and mortar security and you need business finance. And again, really good where a business is growing quickly and the amount of money tied up in debtors, because you're selling so much, the amount tied up in debtors keeps increasing as well. So well worth a look at. Now, I mentioned with the overdrafts that the balance had to go up and down during the month and is supposed to go positive at some stage. If you have core debt means that your overdraft is never going positive, and that means it's basically long-term finance. Now, because the overdraft is an expensive form of finance, if you need that much debt all of the time, don't finance it with an expensive overdraft. Refinance it into a business loan, for example, over 10 years or something, 5, 10 years, which will have a lower interest rate and probably repayments, but at least that way it'll eventually get paid off. So, talking of longer term finance, let's have a closer look at the things that should be financed using longer term finance and the types of finance that are available for that. So, what we're looking at here are bank loans, loans from other people, obviously, if you've got good friends. There's also hire purchase and chattel mortgages. There's leases. Looking internally, you can use your retained profit, so rather than paying out last year's profit to you guys as the owners of the business, you can keep that in the company and keep it reinvested. You can have an equity injection where the owners of the business pop some money in. Angel and venture capital is also quite useful for growing businesses. It's also possible to actually refinance some existing debt-free assets. So we'll talk about the right finance for the right purpose in a second, but that's an important area. And of course, one that's becoming more and more popular too is crowdfunding. So the main point to note here with longer term finance is the term of the finance should match the useful life of the asset financed. So for example, if you buy a car that you plan to keep for 5 years, then get a 5-year car lease. But if you only keep your cars for 3 years before you trade them in, then you'll actually be better off only getting a 3-year car lease. So if you're buying a business, maybe a 3 to 10-year loan so that you eventually pay back your purchase price, or if you're buying a building, well then you get a 20-year mortgage. Now, talking about some differences, people always ask what's the difference between a hire purchase chattel mortgage and a lease. With leases, you don't actually own the asset. You are effectively renting it from the finance company. So the lease payment is the expense or the deductible bit, and you claim 1/11th GST from each payment. So there's usually a residual lump sum payment at the end, and the trick is to try and make sure that the trade-in value of your car or equipment is the same as the residual amount, and then you start all over again with the replacement. With a HP or chattel mortgage, these are very similar to leases, but you do own the equipment. So instead of claiming the monthly payment as an expense, you'll be claiming depreciation and interest. And in addition, you're allowed to claim 1/11 of the whole purchase price of the asset up front as your GST input tax credit. So this can be very useful, and that's why when GST got introduced, we saw a massive uptake or change of people using chattel mortgages instead of leases, because they got that 10% effectively back straight away rather than over the life of the loan. I want to talk about security for a second. Use security to get lower interest rates. So if you ask the bank for a loan, if you give them security, they'll charge you a lower interest rate, because obviously if something goes wrong, they've got a backup plan. But but you have to be careful to use the right security for the right purpose. So, for example, if you use a line of credit secured against your house to buy a car, then that equity is not going to be available later on, for example, to be security for an overdraft, which you might also need. In other words, the bank's not going to take security over your car to satisfy an overdraft. And this is where we were talking about refinancing existing debt-free assets. So, for example, you might have a car that's a couple of years old with no finance on it because you've borrowed the money against your house because the interest rate was cheaper at the time. That's great until you actually need that security to go and finance an overdraft so that your business can grow, in which case maybe you're actually better off going and refinancing the car, do a sale and lease back, for example. That releases the security of your home, for example, which you can then use to be the security for your overdraft. So, just looking at our top 5 finance tips then, just to summarise, make sure you've got the right finance for the right purpose. Use a lease or HP chattel mortgage for your equipment. Use a mortgage to buy property. Use an overdraft or a line of credit for working capital. And that way you get the right mixture of term and interest rates and application fees, that kind of stuff. Second one there, match the finance term to the asset life. So as I said before, if you run your cars for 3 years, get 3-year finance on it. If you keep your cars for 5 years, get a 5-year lease. We do not, therefore, go and buy computers with a 5-year lease. Computers don't last that long before they need upgrading, so, a 2 or 3 year finance at the very most on your computer hardware. Number 3 there is have your finance ready before you need it. This is really critical to keep your bank manager on side and get you the best finance terms. So, in other words, if you wait until the last minute when you're already, bumping zero on your overdraft and then go and ask the bank manager for an overdraft, he doesn't have time to put the application together properly. It shows that you're disorganised and perhaps should be managing your business better, something like that, and therefore they're going to charge you a higher interest rate. There'll be a higher margin on it. Whereas if you can show that you're organised and if you can go in a few months beforehand and say, look, I don't know, Christmas is coming up, it's always quiet in January, we've allowed for X, Y, and Z, but we're going to have a quiet patch, can we please have an overdraft for a month, and you're telling him 2 or 3 months earlier, he can get all the paperwork in place, give you a decent interest rate, and you can go from there. Or there is use secured finance to get lower interest rates. So if you have the security and you want the lower interest rate, then use it. But as I said before, be careful not to give away all of your security on things that perhaps don't need it. But get the lower interest rate. And then, as I said, number 5 there, get the right mix of secured and unsecured finance by not wasting bricks and mortar security on things that can self-secure, for example, a car. Okay, so in terms of what you need to do now, we recommend that you find the time this week to review your short-term cash flow requirements, Review your long-term cash flow requirements, taking into account your strategic plan for your business and what you want to achieve over the next few years, so that you can make sure that you've got the right kind of finances in place to do all those things that you want to do. And review the appropriateness, therefore, of your current sources of finance to see whether there are better options out there for you that will result in either more flexibility, less interest, because you're only paying it on what you use, things like that. So, in summary, how to manage your cash flow efficiently. Need to understand that cash isn't the same as profit. You need to know how much cash and profit your business is making by keeping up-to-date records. So whether you monitor that monthly or quarterly, whatever's appropriate for your business and the stage that you're at and what you've got on your plate. Manage your debtors and creditors efficiently, because they don't cost you interest, or more to the point, they will cost you interest if you're letting your debtors run out. So you're effectively financing them for free. So get that money in as fast as you can so that you save interest on your overdraft. Understand the difference between short-term and long-term cash requirements, and therefore use finance correctly where necessary. So there you go. I'll now hand you back to Angela to talk to you about how you can get a free cash flow review session, and then we'll be happy to answer any questions.
Fabulous. Thank you, Melissa, and thank you, Michael. And thank you, everyone who has been on the line today going through, or rather participating in this webinar. It's great to see that everybody who started at the beginning is still with us now. So you're recognizing that importance for mastering these cash flow keys and what a difference it can make in your own business. But of course, as Michael and Melissa have referenced, we are making available 15 cash flow strategy sessions. So if you'd really like to get a fresh perspective on your cash flow strategy and how to improve things going forward, I'm just popping right now into the text box the hot link to go straight to the page where you can apply for one of those sessions. And of course, it is also on the screen in front of you right now. We have 15 firms across Australia and New Zealand, so we will matchmake you with the firm that's closest to you to organise this session. It can make a real difference to that bottom line of your business, which is what we're all after. And just another couple of pieces of homework, if I may. If we can just flick over to the next slide for me, please, Melissa. Now, it may have been that this could have been your first encounter with DFK and a couple of our wonderful business advisors and referrals from there. But there is, in that case, a lot of other things that you may not be aware of that our firms can provide you with. There's a great slide up at the moment giving you that overview. We cover strategic planning, business management and development advice, business issue analysis, reviews, coaching and board assistance, asset protection strategies, succession planning, and tax planning. So really having fantastic accountants and business advisors on your side can help you get some great advice across all areas of your business. So we certainly welcome any inquiries that you could have. We'd like to speak to one of us and to see if we can help. So I would like to end today's presentation with encouragement for you to go in and to ask for one of those cash flow strategy sessions if it appeals to you, and to give you the opportunity now for any questions that you might have. There's been some popping up during the presentation, which we've answered on the side, and in particular one about, let me check. Invoice, where was it? It was about invoice factoring, but I believe you covered that, Melissa, in your part of the presentation. So just checking in to see if there's anybody else that would like to ask a question. You can type it directly into the chat box, and I'll be able to see that and then direct our attention to it. Or it looks as though, guys, we may have been so darn efficient, we've covered all the questions. But of course, what often happens in these webinars is that you may walk away and start to put the information and the advice into action. And when you're doing that, a question does come up. So please feel free to contact us directly. You can go to dfkanz.com and get directly in contact. Or of course, if you do win one of the strategy sessions, we can go through a whole host of questions that are pertinent to your business specifically. So thanks again for spending your time here with us today. We'll be keeping in contact, both to let you know if you've been able to secure one of those sessions, but also this is the first in a series of business mastery webinars that we'll be providing, and we'd love to welcome you along to the next one. So thanks again for your time. We will be sending out the recording so that you can refer back to some of the advice that was in there that you perhaps like to have beside you whilst you're preparing that cash flow budget, which we know is so important. So thanks for your time and have a wonderful day.